Hey everyone, welcome back to Mangosteen. In this episode, we're going to be analyzing MISTY as if we're a big fancy hedge fund manager in our big fancy suit. And this is to reflect the fact that I got some comments in my email and from people on YouTube and X saying, well, who is this guy? You're anonymous. Do you even know anything? And I was like, well, I said I had credentials. Well, I can't prove them to you because I'm anonymous, but I'm going to show you how to approach this like a big fancy hedge fund manager now. So as I've stated in previous episodes, I've said, look, I have an academic background in finance, economics, accounting, and engineering. I have professional experience across corporate strategy, finance, including time as head of investment and treasury for a multi-billion-dollar corporate. And I want to cultivate the next generation of investors from suits to seal caps through renegade financial education. But of course, I am anonymous, and so there's no ability for anyone to prove any of this. So I thought rather than sit up and reveal my identity, which I don't want to do, I would just go through and show you guys what it's like to be a hedge fund manager and how you would analyze MISTY if you were. So why am I anonymous? Well, where I think Bitcoin is going, even owning a small amount will make you a target. Just like you, I'm trying to keep my family safe. I have a young family. I don't really want them to get caught up in this if in 10 years' time the amount of money I'm dealing with on YouTube suddenly becomes an incredibly large amount of money. I want the quality of my content to be so high it doesn't really matter who I am. And I just kind of like the idea of people getting their financial education from a fruit, like talking at a barbecue, at a family barbecue, and they're like, oh, where did you learn all this stuff about finance? Oh, listen to this guy on the internet. He's a fruit. He's a mangosteen. And I spend a lot of time disparaging the establishment a lot, and I don't want that to come back to bite me. And the anonymity allows me to speak freely. And so this is kind of why I've chosen to be anonymous, at least for now. So, hedge fund managers. We're going to put on our big fancy suit and our fancy watch, and we're going to pretend that we care about you, and we're going to act like we're a super professional. And analyze MISTY as if we were a hedge fund manager. There's one concept that I want to bring into the chat before we go into detail analyzing it like a hedge fund manager, because I want everyone to start at the same point, and that is this idea of arbitrage. Now, a very simple example of arbitrage is we've got shop A and shop B, and let's just say that they're basically next door to each other. There's no shipping or transaction costs. Now, Shop A sells Pepsi for $2.50. Shop B sells Pepsi for $3.50. Now, some sort of Pepsi trader could intermediate these two shops, and they would buy Pepsi for $2.50 at Shop A, and they would sell it at Shop B for $3.50. Now, the idea, or essentially next door, and they would drive up the demand for Pepsi at this shop such that Shop A would increase their prices, and they would increase the supply at Shop B such their price would go down until the same point these two shops are trading at the same price because they're basically co-located. So there's no reason for them to charge a different price. So that is the most simplest example of arbitrage that I can think of. Now, there is a more important form of arbitrage called asset risk arbitrage, where if you've got two assets, let's say asset A or asset B, they could be shares in the share market, for example. And let's say the share price of asset A is $5 and it pays a $1 dividend. It's 20% dividend yield. And asset B has a share price of $10. It pays a $1 dividend, a 10% dividend yield. Now, if we assume that they both have the same amount of shares outstanding, they have the same amount of market capitalization, then if asset A and asset B have the same risk profile, let's say that they just, their expected risk in the market, the volatility of their asset price and the volatility of their earnings is similar or the same, then hedge fund manager, would buy $5 of the same risk-adjusted dividend and sell or short the $10. So what a hedge fund manager would do is say, oh, I'm going to buy asset A and I'm going to sell asset B, or I'm going to go long asset A and I'm going to go short asset B, with the idea that these assets' prices would then converge and they would profit from the downward movement in asset B and they would profit from the upward movement in asset A until the point at which they reached equilibrium or the same price. Now, that is the core kind of tenet of hedge fund management, is this idea of asset risk arbitrage. And generating asset risk arbitrage is called generating alpha. And if you've listened to any guy on the internet talk about finance, they're generally faffing on about how they're so good at creating alpha. This channel gives so much alpha. This strategy guru has so much alpha to offer. Follow me for more opportunities for alpha. What is alpha? Alpha is the measure of someone's ability to outperform the expected benchmark return. Alpha is your return minus that benchmark return, which is, generally some sort of market return. And it's a pretty important concept. People in the hedge fund industry like to apply it, and it, won the William Sharp, who created it, a Nobel Prize, and so I think people consider it pretty important, and it is. It's sort of the fundamental concept from which you price all assets in the financial markets. So, what is the optimal portfolio? So when we're looking at all these different assets in the market, it could be Apple, Tesla, Google, whatever, some sort of blend or portfolio of these assets will be a blend that is optimal. They'll have different variances and covariances and correlations and risk return profiles in themselves, and then they will blend into this optimal portfolio, which is the best expected return for the best expected risk that you can experience in the market. And that is the idea that any portfolio manager worth his salt should, or worth their salt, should invest across the capital asset line, which is basically this optimal portfolio between cash and the risk-free rate, the optimal portfolio. Or if they want to go higher up the risk curve, they should just take on leverage or debt in order to buy more of the portfolio. But that is the optimal return. And the idea of alpha is that for that expected return and expected risk, you have experienced the same level of risk for a higher expected return. And so that is this idea of like asset risk arbitrage. You're like just generating return over and above what the market can. And this is a really important concept because this is how a hedge fund manager would look at MISTY. So let's look at MISTY from this lens. Here is us trying to determine where MISTY sits on the capital asset line, or the capital market line, I should say. Now, like we said, let's say that, for example, the ideal market portfolio has a 10% expected return and has a 2% expected variance to represent that expected risk. Now, we know that the dividends on MISTY are like 80, 90 to 100%. And so suddenly we've got a vastly higher asset that is sitting on the expected return line, right? It's like way up here, like, whoa, way out in the atmosphere, 10 times higher than the market. Now, the hedge fund manager is going to say, well, if it's 10 times higher on the market, then I'm expected to tolerate more risk in exchange for that return. And that's exactly what the capital asset line allows you to do. You go 80% fair valued, well, that would be, let's say 20% variance, given that you're approximately 10 times the return of the market. It's not a perfectly linear correlation, but the idea is that that's what you're doing. Now, if, for example, MISTY was experiencing the same risk as your normal share market share, then this would mean that MISTY is undervalued. And what the market would do is push MISTY's price up until its expected return met the market. And if it was undervalued, then you'd be experiencing more risk than what the market would tolerate for that return, and its price would decline to the point where its expected return would travel up onto the capital asset line somewhere up here, right? And if it was fair valued, then it would be priced about right. So how do we know which one it is? So the whole market is looking for these risk arbitrage opportunities all the time. And we can conclude that MISTY is fair valued because if it were undervalued, its price would appreciate from $21 to like $180 to $210 the same day that it launched, right? Its IPO price was $21, and if it was somehow undervalued and it experienced the same normal risk of a share, then its price would suddenly bump up to the point where its dividend had collapsed to a market dividend rate, and its price would have 10x. Now, that did not happen, did it? Now, if MISTY was overvalued, its price would decline from $21 to same day to some sort of price that reflected its true risk. Now, that didn't really happen either. The price behaved generally as you'd expect for the product, and so I'm quite comfortable to say that MISTY is fair valued on a return to risk basis. So the final question we have to ask ourselves is, what is this risk? And the beauty of MISTY, and this is why I really like MISTY, is that it does exactly what it's expected to do on the can. Its underlying mechanics expose the risk that you're experiencing, and that is this full downside exposure in exchange for a fixed upside. So when MicroStrategy's price goes up, you receive the option premium, but when MicroStrategy's price goes down, you are fully exposed to any downside, and that is the risk. That is why you're getting this fat, juicy dividend to pay for the fact that you're experiencing this risk. And that's why hedge fund managers haven't arbitraged out the MISTY product and pushed its price up to the stratosphere because the risk that you're experiencing is fairly valued. And then, of course, we have winter that is the opposite. And so that is why MISTY is behaving in the market exactly as it's supposed to, because any hedge fund manager worth their salt knows this risk profile and has priced it fairly into their portfolio and have decided to either buy it or hold it in a certain percentage or not hold it at all because it doesn't meet their mandate. So that is why MISTY is not a risk-free asset. It doesn't behave like a share. It has a very distinct payoff profile that generates a very distinct risk that you need to be paid for to compensate for that risk. And I mean, if you don't believe me on this, I'm going to put a short clip from YieldMax themselves that explains this exactly to you now.
Upside movement, any cover call strategy is desired, especially the way we do it at YieldMax with spreads. But more importantly is the worst case scenario, right? And I probably talk more about this than anybody else. You are long the stock. You are long MicroStrategy risk. We talked about you're long Bitcoin risk, right? So you don't want MicroStrategy to go down, right? If you're bearish MicroStrategy, then you know MISTY is the wrong position for you. You should buy the inverse, which is winter, WNTR, because we do have some inverses, right? When I talk about some of the innovative products out there, having an inverse on MSTY is important, right? Have winter, right? It's the same thing. It's a covered put instead of a covered call. It's bearish with selling puts instead of selling calls. But we don't, I know you don't want to get into that one too much, but I think it's worth talking about it in the same breath because we give people the option based on their bullish or bearish. So worst case scenario for MISTY is if MicroStrategy tomorrow is down 25%, MISTY will be down 23%, right? Yes, you lost a little less, but nobody's feeling good about losing 23%, right? That doesn't feel good. So I think it's important that people recognize that you're taking single stock risk when you're using a single stock ETF like MSTY, right? You're taking idiosyncratic risk.
So here Jay has provided a really, really balanced and well-formulated explanation of exactly what MISTY is and what it is not. And he's also provided the solution in the same breath. So he's done a fantastic job of selling the YieldMax products here. And so we're going to explore this in a bit of detail. So what he's saying is that you are fundamentally long MicroStrategy and long Bitcoin risk. And that is because this here graph on the left represents the payout option or payout structure of the MISTY product. And that is if the price goes down, and like he said, 25%, MISTY will go down 23%, and it sucks. But also that higher option premium is coming and reflecting also the higher likelihood of this occurring. And so you need to be careful about how you buy this. Now, the MISTY product is fundamentally something that relies on a bullish outlook on Bitcoin and MicroStrategy. And what he said in the next breath is winter is their inverse product. This is the product that provides the option premium and takes a loss if MicroStrategy price goes up. And so the key thing to understand is that if you want to generate all-weather income, you need to use both products. So again, I still have my 20% discount operating for Black Friday. So if you are interested in understanding my MISTY winter rebalancing approach, then Mangosteen Private is for you. Otherwise, I hope you've enjoyed the episode. Thanks, everyone. So I hope you found this episode enlightening, guys. I hope you've seen that I'm telling things exactly from the book from YieldMax themselves. And you know, they've represented their product fairly. It's just that it's quite a complex product that you need to understand in detail before you can jump into it. And that comes back to my idea of, you know, actively managing your MISTY winter balance so that you can generate all-weather income. Now, of course, this channel does not provide financial advice or any advice of any kind. Everything here is general information only and for entertainment purposes only. It does not consider your personal objectives, financial situations, or needs. Reference to any financial products are factual only, and you do not constitute recommendations. You must do your own research. Any investment or trading decision you make, you're entirely your own. This is entertainment only. You are listening to a random Mangosteen on the internet.